Good afternoon, everyone, and welcome to the Pitcher Partners year-end tax planning session. For those who don't know who I am, my name's Daniel Burt. I'm a tax partner here in Pitcher Partners. I've been with the firm for about 9 years and have been a partner for about 12 months. Before we really get into the session this afternoon, just a quick reminder that Pitcher Partners do have our annual tax planning toolkit. We publish this each year, and it's now an interactive PDF, which outlines key tax issues that can be considered before year end. Each year it's updated for new developments and, if relevant, budget announcements. The toolkit is specifically tailored for taxpayers in the middle market and covers both corporate taxpayers and private groups. The 2023 toolkit is soon to be released, and we hope to do that in the next few days. Please talk to your usual Pitcher Partners contact once you've received the toolkit to work through any year-end tax planning matters. Now, this slide just gives you an overview of what we're going to consider this afternoon from a year-end tax planning perspective. The first item will be some general tax planning considerations. This should hopefully be a refresher for many of you on the call, looking at some of those key year-end items. We'll also be focusing on some key items for individuals, as well as trusts and companies. Be a particular focus this year on trusts. It's been a fairly big 12 months, both from the ATO perspective and from some key court decisions looking at trusts and trust distributions. So we will spend a bit of time talking about these developments and what it means for you in the lead into 30 June. So the first key item today is around general year-end tax planning considerations. There's a list here that you can see on the screen, which are your standard year-end items. One of the key items is around the timing of income and timing of deductions. From a deductibility perspective, an expense would need to be incurred for a tax deduction to be available. There's a lot of guidance on what the meaning of incurred means, and without going into too much detail, a broad guide is that you incur an outgoing at the time you owe a present money debt that you cannot escape. You don't have to have paid the money, provided that you're definitely committed to making the expenditure in the year of income. So a key item for year-end tax planning is around sort of accrued expenses. Is the business definitely committed to making that expenditure, or is it merely just an estimate of potential future outgoings? From an income perspective, you need to consider whether income or whether a receipt is derived. And a key concept there is whether there is a recoverable debt, which is the term that we use to describe the point in time at which a taxpayer is legally entitled to an ascertainable amount as a result of having performed an agreed task. In addition to just considering income and expenses, you review large transactions that have occurred throughout the year, not just from I guess looking at the transaction to making sure that any sales, revenue, capital issues have been considered, but also transaction costs. Large transactions often have large transaction costs, and you need to consider whether those transaction costs are deductible, whether they're capital in nature and non-deductible at all, or whether they might be able to be eligible for a deduction over 5 years under the black hole expenditure rules. In relation to prepaid expenses, not all prepaid expenses are deductible. However, some are. So it's important to understand, which prepaid expenses may be eligible for a tax deduction. Some common amounts that can be deductible are amounts that are less than $1,000. Amounts required to be incurred by a court order or a law of the Commonwealth. Typically, they're things like prepaid workers' compensation. Prepaid salary and wages should also be an allowable deduction. And for medium businesses, turnover less than $50 million, most prepaid expenses should be deductible, provided the eligible service period does not exceed 12 months. In relation to bad debts, a key item in the lead up to 30 June is look at those debts that might be doubtful or bad and ensure that they are written off formally before the end of the year. The ATO have some public rulings on when a bad debt deduction would be available, and it's important that the business essentially formalises the writing off of those bad debts prior to 30 June. Now, if it's not a debt and it's a loan, for example, then generally a deduction is not available for writing off a loan, but a capital loss may be available subject to a number of factors. If the loan's to a related party, you might need to consider the application of the commercial debt forgiveness rules for the debtor. These rules can be complex, so please contact your usual Pitcher Partners representatives if you need some further assistance. Another key item is trading stock and the trading stock election. So under the trading stock rules, if the market value of the trading stock has fallen, you can write that value back down for tax purposes, and that can actually bring forward a tax deduction. And that's the case whether your trading stock is tangible goods, whether it's property or any other sort of item that would be trading stock. You've got that ability to write up or write down the value of trading stock and make that election. Bonuses and accruals are sort of that ties into the discussion earlier on deductibility and whether you're definitely committed to making the payment or whether it's just an estimate. Gifts and donations. If you're making a gift to a deductible gift recipient, that should be an allowable deduction, but just be mindful that if the taxpayer that's made the donation is in a taxable loss for the year, that the deduction may not be available. However, you can elect to spread that donation over a period of 5 years to essentially push that deduction into a future subsequent income year. From a tax loss perspective, depending on the entity type that you're carrying on business in, it will depend on whether tax losses may or may not be available, but it's important to review tax losses. If we're talking about a company, consider whether there's been any change of ownership and whether the continuity of ownership test has been satisfied. If it hasn't and there's been a significant change of ownership, then the losses may be available if the business continuity test has been satisfied. And if we're talking about trusts, the rules are a bit more complex because depending on the type of trust, whether it's a fixed trust or a non-fixed trust, and whether family trust elections have been made, that can determine which trust loss rules you need to satisfy. Okay, so now we've sort of gone over the usual year-end items. We'll move into a discussion on individuals. The first slide here shows the individual tax rates for residents, both for the current income year and for the next income year. As you can see, there actually isn't going to be a change from 2023 to 2024. From previous years, we had the low and medium income tax offset. That's been abolished, but the low income tax offset is still there. The LITO can apply if your taxable income is less than $37,500, in which case you get the full offset of $700. And the quantum of that offset available sort of phases out until your taxable income hits a bit over $66,000. Whilst it's not relevant for year-end matters this year, a key area of focus and interest is what's going to happen with the stage 3 tax cuts. They are slated to come in from 1 July next year, and we'll essentially see the 37% tax bracket abolished and the 45% tax rate kicking in from $200,000 and up. The Labor government have been clear to date that they intend to honour the commitments for the stage 3 tax cuts to be brought in. But with the current budget and economy, we'll wait and see what ultimately happens. There may be an announcement in next year's budget in May, but we'll have to wait and see. So this slide just provides, I guess, an indication of the maximum fully franked dividend that a company could pay to an individual before there's any additional top-up tax payable. And as you can see, depending on whether the company franks at a 30% franking rate or franks at the 25% franking rate, that can have a significant difference in the quantum of a dividend that the company can pay without the individual having a top-up tax liability. So if the company's on a 30% franking rate, the highest cash dividend that can be paid is just a touch over $116,000. And once you gross up that dividend for the franking credits and apply the marginal tax rates and the Medicare levy, you'll find that there's zero top-up tax payable. Conversely, though, if the company's on the reduced franking rate of 25%, that maximum cash dividend that can be paid reduces down to $75,000. So that's a fairly significant reduction of over $40,000 in terms of the maximum cash dividend that can be paid before any top-up tax needs to be paid at the individual shareholder level. And it sort of demonstrates, I guess, the flow and consequences of the reduction in the corporate tax rate over the last couple of years, how we do now have this two-tiered system. Is that, when the company tax rate reduces, that's really pushing that tax burden onto the individuals, who then have to pay a higher top-up tax liability when they receive that franked dividend that's been franked at the lower rate. Now, some other items of interest this year, and the first one has been a key focus over the last couple of years with COVID and a lot of people working from home more than otherwise has been the case historically. For the 2023 year, the working from home expenses are calculated at a rate of 67 cents per hour. This is different to previous years where last year we had a 52 cent rate or an 80 cent shortcut method, but this year it is a 67 cents per hour. And that is, in addition to that, you can also claim depreciation of equipment and furniture. Now, the ATO has published that in order to be eligible for the working from home expenses claim, you must be undertaking your employment duties at home and not just checking emails or doing other administrative matters at night. And you must incur additional running expenses as a result of working from home. A key obvious one, now that we're coming into a cold Melbourne winter, would be power and gas bills if you're at home for additional hours. From a superannuation perspective, the maximum concessional contribution for this year is $27,500, and so that would include your employer mandatory contributions as well as any contributions which you're claiming as a tax deduction. In relation to catch-up concessional contributions, if your contributions in a year are less than $27,500, you're actually able to accrue any unused cap for up to 5 years and make a catch-up contribution. One of the key requirements here, though, is that your super balance must be less than $500,000 in order to be eligible for the catch-up concessions. Non-concessional caps in 2023 is $110,000. So that's the contributions where you're not eligible for a personal tax deduction. Again, not quite relevant to year-end tax planning, but it'd be remiss not to mention the government's recent announcements on superannuation reform, in which an additional 15% tax is to be imposed on those super funds that have a balance over $3 million. Whilst these rules are slated to kick in from 1 July 2025, and the government does seem committed to these rules, a key sticking point has been one of the key sticking points is that Treasury are looking to impose this 15% additional tax on unrealised gains, which is against long understood practice of the capital gains tax regime, where you only pay tax on realised gains. So that doesn't kick in for another 2 years, but important just to flag that one on the call. Another really important item that we should all be aware of, whether it's for ourselves or for our kids, is in relation to the indexation of HECS and HELP debts. So from 1 July, so in about a week's time, all HECS debts and HELP debts are going to be increased by a factor of 7.1%. So it might be relevant to consider making voluntary repayments or repaying in full before that debt is going to be indexed by a factor of 7.1%. And as we've shown at the bottom, the super rate, the SG rate, is going to increase to 11% from 1 July 2023. Depending on how employment contracts are worded, that might result in some staff taking home less after-tax pay. The downsizer contribution. We've seen over the last couple of years that the age limit for the downsizer contribution has gradually come down. So it used to be the age of 65. From 1 July 2022, it reduced to 60. However, from 1 January this year, that age is reduced down to individuals over 55. And really, if individuals sell their family home, they can contribute between them. If you've got a couple, up to $600,000 can be contributed, $300,000 per person, $600,000 per couple. There are a couple of key conditions that need to be satisfied for the downsizer contribution to be available, which are there on the screen. And they look at, you must have owned the home for at least 10 years. The house must be eligible for a main residence exemption, and the contribution must be made within 90 days of settlement. Now, a question we get all the time is, what are the ATO focus areas leading into tax time? And often for individuals, these items may not change much from year to year. We'll find that things like rental property deductions and interest deductions are always on the ATO's radar. Data matching for sales of shares and cryptocurrency have been on ATO's radar for the last couple of years. But a key thing, I think the ATO have been very vocal around short stay accommodation, and whether taxpayers are claiming or apportioning deductions for things like interest on loans, where the house may not be genuinely available for rental use all year. Another key watch out is for interest deductions on loans that might have a combined business purpose and a non-business purpose. The important test for whether interest is deductible is the use of the borrowed funds, rather than the security that's being used to borrow the funds. So a common example might be if you've got a business loan or a loan that's funding an investment property. If you redraw against that loan and use that to go on a holiday, then that redraw shouldn't be allowed. The interest on that redraw shouldn't be an allowable deduction. So that's just a watch out there. If you have redrawn against some business loans or some investment property loans and use those for private purposes, the ATO has again flagged that as a watch out. So the next topic we're going to talk to is around the area of trusts. And trusts, and in particular discretionary trusts, are often a large part of our year-end tax planning seminars, and this year is no different. In the past 12 months, we've had the ATO's final guidance on Section 100A, which we'll discuss shortly. Also had a large number of full federal court cases on Section 100A and Part 4A, which are relevant for trust distributions. These cases include Guardian and B-Blood, and whilst we won't go into too much detail on these cases, they will be referred to when we talk to 100A. Also a non-tax case, the Owies case, which we'll talk to on the following slide, which again is directly relevant for trust distributions. As a result of the 100A changes and these court cases, there's never been a greater focus on discretionary trusts and the distribution of income to beneficiaries. So here's a list of 9 key items to consider when you're preparing your year-end trustee resolutions. If any of you on the call have met Terry Murphy, QC, KC as it now is, he's got a 2-step process when you're considering trust matters. Step 1 is read the deed. Step 2 is read the deed. And that is very, very important, because without reading the trust deed, you may not know whether you're following the due process in terms of whether a trustee resolution might need to have a guardian or a consent, or you might need 2 directors of the corporate trustee to approve and sign a resolution. So it's important, read the trust deed and be familiar with the processes that must be followed in terms of that year-end distribution of income. Another key item is the definition of income, whether it's ordinary principles, whether it's Section 95, which is obviously a tax concept there. In some trust deeds, the trustee has the power to define income as differently. So it's important to know what the definition of income is, and also important to know what the income and expenses are leading into 30 June. If a trust doesn't have any distributable income for trust law purposes, but does have taxable income for tax purposes, what would generally happen in that situation is, because there's no distribution out of the trust, any taxable income is then taxed in the hands of the trustee. And that can mean things like discount capital gains or franked dividends mightn't be able to be taxed as favourably as they otherwise would have had they been distributed through to ultimate individual beneficiaries. So it's key to get an idea of what the income and expenses are and whether you are in a overall profit or loss position leading into 30 June. Other key items are reviewing, family trust elections, interposed entity elections. An issue we're seeing, more and more over the last couple of years is trusts with different specified individuals, often a husband or a wife, or potentially 2 brothers, who are looking to distribute to each other's discretionary trusts, or from brother A to distribute to brother B, for example. And whilst that can be done, if there are different family trust elections in place, it generally requires an interposed entity election to be made by one or both of those trusts to manage issues such as family trust distribution tax or income injection test reasons. So please consider FTEs and IEEs. Another key watch out is that a trust can only make one interposed entity election. So it can't make multiple interposed entity elections. So please be careful around that. If you're streaming, franked dividends or capital gains, please again read the deed and see what any specific, whether that can be done, whether the trust deed permits streaming, and what processes may need to be followed there. In terms of how to draft your year-end resolutions, the focus now is really focus on the intent, rather than referencing every clause in the deed within your year-end trust resolution. Now I think the focus is just focus on the intention of the trustee and what the intention is around the distribution of income. Obviously, if you're distributing to new beneficiaries, you need to obtain their tax file numbers. And please be careful in relation to distributions to loss entities, particularly in the situation where you may not have a family trust elected group. It does get a little bit easier if the entities involved are in a family trust elected group, but just need to be careful there. The bottom there, I've mentioned the OWIS case, which is a non-tax case, but it was decided last year. It's not a very common surname, OWIS, but I know there is a footballer for Carlton running around with the same surname. And much like Carlton hasn't had much success in recent weeks, Mr. OWIS didn't have much success in receiving trust distributions from his parents' family trust. So much so, he took them to court. What the case really did consider was a discretionary trust that had 3 specified beneficiaries, who are the 3 kids of the parents. And over a period of years, the trustee distributed income to the parents and one of the kids, but not to 2 of the children who had become estranged. The matter went to court, and the judge found that the trustee had not given any real or genuine consideration in the exercise of its discretion to 2 of the specified beneficiaries. And the judge found that the distributions were voidable and actually removed the trustee and appointed a new trustee of the trust. So this is a real key watch out. It's a really significant development over the past 12 months in terms of discretionary trusts distributing income. And especially in a situation where you might have a family unit that might have become estranged, or it mightn't be the ideal harmonious family situation to make sure that the trustee is giving genuine consideration to potential class of beneficiaries. And that's a key watch out this year in making those trustee resolutions. Whether that means you need to document thought processes behind considering the needs of each beneficiary. I guess the key for this case is just need to be careful in preparing those resolutions and what consideration is given to the potential beneficiaries. Now, moving on to a very hot topic is Section 100A. So a bit of background. So in February last year, the ATO released a suite of draft documents that looked at Section 100A and Division 7A. These included tax rulings, taxpayer alerts, practical compliance guidelines. And at the time, they created a bit of a stir in the accounting and business community as they were changing the treatment of trust, a long-standing treatment of trust distributions for tax purposes. There was extensive consultation during this period, and as an early Christmas present to tax advisors in December last year, the ATO released final versions of these documents, which you can see on the screen there. So we've got tax ruling 2022-4, practical compliance guideline 2022-2, and from a 100A perspective, we have taxpayer alert 2022-1. And so these are really, without any fundamental change in the law on 100A, the ATO have released these documents and I guess flagged their intent to review private group trust distributions and flagged a change to long-standing practices that have previously been essentially well understood and accepted within the tax community. And we'll talk to what 100A is and what these changes mean on the next couple of slides. So first question many of you might have, what is Section 100A and when can it apply? Section 100A, it's not a new provision. It's been around since 1979, and until recently was thought to be well understood by the tax profession. It's designed to capture, 100A is designed to capture trust distributions to certain beneficiaries where there's a tax reduction purpose associated with that distribution. And 100A should only apply where there is essentially a reimbursement agreement. And that can broadly be viewed as where a distribution goes to one entity and the financial or economic advantages of that distribution go to another person. And so a common example might be a distribution to an adult child who might be over 18 but might be going through university. If the trust distributed income to that adult child, but the actual underlying cash was lent to the parent or gifted to a parent or retained in the trust, that is the type of arrangement the ATO flag that they're going to look at. However, Section 100A should only apply where there is a reimbursement agreement. So if a trust distributes income to an individual, even an individual who's on a low marginal tax rate, provided the cash follows that individual, then Section 100A shouldn't apply. It does apply, though, where the distribution goes to an individual or an entity. They pay a lower amount of tax than would have potentially been the case otherwise, and then that cash or the economic benefit is enjoyed by somebody else. One of the really interesting developments, though, with the ATO's documents is around an exception to Section 100A. So 100A shouldn't apply where the arrangement is an ordinary family or commercial dealing. And that concept had been generally thought to be well understood up until the ATO's release of these documents. And whilst there has been some recent court cases on Section 100A, they probably really haven't focused on the issues that the ATO, some of the issues that the ATO are focusing on in these documents around distributions to adult children and things like that. Now, a key where Section 100A does apply, the beneficiary is actually deemed to not be presently entitled, and instead the trustee is assessed under Section 99A, so essentially taxed at the top marginal rate. So it can make a material difference to the tax payable under a trust distribution. Another key item which is noted at the bottom is that Section 100A has an unlimited period of review. And so that can be contrasted to the normal period of review that might be 2 years or 4 years. For Section 100A matters, the ATO, the Commissioner, can theoretically go back to 1979. So we'll now talk to one of the ATO publications and focus on Practical Compliance Guideline 2022-2. Before I get to 2022-2, there is the tax ruling, which I mentioned before. That's I guess a very technical document and considers a lot of technical tax questions around nexus between a distribution and a reimbursement agreement. And it does contain some examples, but the PCG, which is the Practical Compliance Guideline, goes through and provides a lot of practical examples on when 100A may or may not apply and it tries to stratify each of a number of arrangements into a different coloured zone. And as you can see on the screen there are 3 coloured zones: white, green and red. And the ATO have gone through a lot of examples to work out when things might be in the white, green and red zone. You might recall when the ATO issued their draft PCG, they also had a 4th colour, which was the blue zone. And essentially the blue zone was items that the ATO were yet to really have a view on. So they weren't quite green, they weren't quite red, so they were put into the blue zone, and that really caused a bit of uncertainty. So in the final PCG, the ATO has removed the blue zone, and we only have the three coloured zones. The white zone applies to arrangements entered into before July 2014, but the arrangement, if the arrangement is outside the green zone or otherwise subject to review, the ATO might still look at that transaction. And this ties into the fact the ATO do have an unlimited period of review for Section 100A matters. I think, personally, if you'd ask me the question, would the ATO go back, from 2014 and earlier? I think only in the most aggressive, egregious arrangements would the ATO look to do that. But the thing is that they have got an unlimited period of review. So at law, they could go back to 1979 if they wanted to look at these sort of arrangements. Unlikely that they would go back to 1979, but because they've got this unlimited period of review, theoretically, they can do that. From a green zone perspective, what the green zone means is that the ATO still may ask questions on certain arrangements and trust distributions, but if they confirm that an arrangement is a green zone, then they should essentially ask no more questions on that arrangement. They'll confirm that it's in the green zone and not ask any further questions. And in our experience, what we've seen over the last sort of 12 months with the ATO reviews is that they are looking at trust distributions. They're looking at all the UPE or loan ledgers between the trust and the beneficiaries, seeing if there's been any repayments or things like that. So the ATO are looking at this at the moment and will continue to going forward. In terms of what arrangements fit into the green zone, some of these include a distribution to a family member where the funds are actually paid to the beneficiary and used to meet personal expenditure, to meet donations or superannuation contributions. Another green zone arrangement is distribution where the beneficiary receives the funds within 2 years. So that's really important that the cash doesn't need to follow the distribution immediately. The trustee can have up to 24 months to actually pay the distribution to the beneficiary and still fit within the ATO's green zone category. Another item for green zone revolves around a situation where the trustee retains the funds, but depending on various features will determine whether a retention of funds situation is either in green zone or a red zone. And we'll talk to a retention of funds situation in the next couple of slides. In terms of what the red zone is, now red zone doesn't mean that 100A will apply. But if an arrangement is in the red zone and the ATO look into the matter, expect them to put additional compliance resources to understanding the arrangement. It doesn't mean that 100A will absolutely apply, but expect to get further questions if there are some arrangements that fit into the red zone. I'll just repeat a quote that the ATO has put into the PCG, and it says, and it sort of confirms what I've just talking to there. When an arrangement is described in the red zone, it doesn't necessarily mean that Section 100A applies to the arrangement. The relevance of an arrangement being in the red zone means that it attracts our attention, and we will dedicate compliance resources as a matter of priority. Some examples of red zones are a distribution to a beneficiary who then gives their entitlement. And so that could be a distribution to an adult child who then gives the cash back to their parents who might be on a higher marginal tax rate. Another red zone is where income is essentially returned to the trust. And that's a situation commonly known as a washing machine arrangement, where you've got a company owned by a trust, and in 1 year the company pays a dividend to the trust, and the next year the trust distributes that dividend to that same company, and it just circulates around and around, and that sort of defers that top-up tax indefinitely. And the ATO have flagged that as an arrangement for some years now that they don't like, and that's confirmed again in this PCG. Red zone arrangements can also include where an unpaid entitlement is satisfied by way of an issue of new units. It won't apply in all instances, but where the market value is not commensurate with the amount of the distribution, that can push you into a red zone arrangement. Another key red zone arrangement is differences in tax and accounting distributions. And this is really what we've seen in the recent court cases the ATO have taken on 100A, is where there's really, where there's a permanent difference. So where cash has been able to be extracted from a corporate or from out of a group in the hands of individuals and tax capped at the company tax rate. They're the sort of arrangements that we've seen that the ATO are really focusing on, where there's been permanent differences that might have arisen from differences in tax and accounting distributions. Another red zone example are distributions to an entity with losses, but importantly, only to entities outside a family group. So if you've got a family trust elected group, that should be okay in terms of that red zone assessment. The next slide is just a really simple example to demonstrate sort of what we've been talking to over the last sort of 5-10 minutes is this concept of a reimbursement agreement. That we've got the XYZ family trust. There's a present entitlement to income, and this might be an individual who, whilst being over 18, might have limited income in their own name, and so they're subject to tax on that distribution, but the funds are actually provided to, as we were saying earlier, to their parents who are on much higher marginal tax rates. And that's the sort of arrangement that the ATO have flagged in the practical compliance guideline as something that might be red zone. Now, I mentioned earlier that an exception to Section 100A is something that's an ordinary family or commercial dealing. And what had been sort of well understood is that distributing income within a family group and the funds not necessarily flowing to that beneficiary might be an example of an ordinary family or commercial dealing. But the ATO have said in this PCG that is an arrangement they're going to put compliance resources to. And in the taxpayer alert that they published, had that exact situation very clearly, where a distribution goes to an adult child who then gifts the money back to their parents who are on a higher marginal tax rates, that the ATO have flagged in that taxpayer alert, they will put compliance resources towards that. So what are some key themes coming out of the ATO's products on Section 100A? A key theme and a real important area of focus as we come into 30 June is this ordinary family or commercial dealing exception. The ATO have said in these documents, and again, I'll repeat here from what's in the documentation, if the objective of a dealing can be properly explained as the payment of less tax to maximise group wealth, rather than some other objective, which is a family or commercial objective, it is not an ordinary family or commercial dealing. Now, this is really where there's been, a change of long-standing view of when 100A may or may not apply. But leading into 30 June and doing our trust distributions, we need to be aware of the ATO's approach here. There isn't as yet a court case looking at distributions to, or a test case looking at distributions to adult children, but the ATO have flagged that this is an item that they're going to look at. The trustee retention of funds, we'll talk to that on the following slide. And so I'll touch on, and we've also touched on distributions to loss entities. That should be fine as long as it's within a family trust elected group. In terms of the final point, the artificial or contrived arrangements, that's really where we've seen to date, the ATO focus on the court and these matters going to court. Items where there are circular flow of funds or where there are permanent differences where the tax has been able to be capped at the 30% rate and the cash taken out of the group and in the hands of the individuals. In terms of the retention of trustee retention of funds, there's obviously a very, very common situation where you've got a business carried on in a trust. Obviously, it needs to transfer or distribute all of its taxable income each year. But if the business is growing, then often that cash is needed within the business to fund working capital and growth. So it's often not practical for a trustee to distribute all of that distribution to the beneficiaries because of the nature of the business activities being carried on in the trust. Similarly, the trust might want to use that cash to repay debt that might have financed an income-producing asset, or the trust might want to buy another income-producing asset. So it's a very common situation where there's a distribution to beneficiaries, but the funds are actually retained within the trust for a number of purposes. In the PCG that the ATO has released, you can fit into the green zone, depending on a number of factors here. So there's two sub-scenarios, 3A and 3B. In scenario 3A, that's the concept where the trust distributes income to individuals, but it's limited, the green zone outcome is limited to arrangements where the distribution is to the controller of the trust or their spouse. But provided that distribution is to the controller or their spouse, that UPE, it can be interest-free, so interest does not need to be charged on that, and you can still fall within the green zone. In relation to distributions to non-individuals, so controlled companies or other trusts, that's considered in scenario 3B in the PCG. And so you can still fall within the green zone for distributions to trusts or companies, but the key difference here is that the loan or the UPE needs to be on commercial terms. And when we say commercial terms, we really mean that it's put on terms equivalent to a Division 7A loan with that minimum interest rate being charged. Where there are distributions to, whether it be to an individual or to a company or trust, to stay within the green zone, the trust actually still needs to use the actual underlying cash for some limited purposes. It can be for working capital, it can be to buy an investment asset, but an exclusion from being in the green zone is where an associate, so an associate of the controller, benefits in some other way. And so you can have, and what the practical flow and consequence of this means is you can have a situation where the funds are retained within the trust might buy a holiday house or a beach house. And if someone other than the controller of that trust uses the beach house and doesn't pay market rent to use the beach house, then that takes you out of the green zone in terms of the ATO's eyes. Now, if letting your brother or your sister or your cousin use your beach house isn't an example of an ordinary family or commercial dealing, I really don't know what is, but in terms of what the ATO has put in these documents, where that asset is used by someone other than the controller of the trust, it can take you out of green zone. Importantly, it doesn't mean that 100A will apply, but it takes you out of that green zone assessment and moves you into a situation where the ATO might ask additional follow-up questions. So what are some key takeaways for Section 100A? I guess, please consider, whilst discretionary trusts may have had a long-standing practice of distributing income and adopting similar methodologies over the last couple of years, have a think and see, this year, where that distribution is going to go. Will the cash follow, or will the funds be retained within the trust? Because dealing with UPEs, or whether the amounts are actually paid to beneficiaries, can actually make a huge impact on whether you're going to be green zone or red zone. But yeah, please ensure you've got appropriate record keeping. If the ATO was to look at arrangements, being able to lead evidence and show why certain decisions may or may not have been undertaken, can assist. I think it wouldn't be unreasonable to say that if there was a distribution to a family member at 30 June, but then not long after 30 June, the family situation changed and a family member needed, the cash, and that's why the distribution wasn't discharged and paid in full. If there's evidence to support, that's why the distribution wasn't paid, that can only assist in the context of an ATO review. Some other trust matters which we'll talk to here is around a situation where we're looking at funds or loans into a trust. So we might have a Division 7A loan for an individual to a trust, but then an interest-free loan to another trust which has been used to fund an income-producing asset. And it doesn't automatically follow that that interest on that interest-bearing loan that's then been used to fund an interest-free loan into a trust may necessarily be deductible. In a corporate group, there's a well-known case, Total Holdings, where a company borrowed at interest and lent into its subsidiary interest-free and was able to claim deductions on that interest because the interest-free loan it made was advancing the income-producing purpose of the assets of the subsidiary. The difference with discretionary trusts is if the individual who has borrowed at interest and lent into the trust, if they're only a discretionary object of the trust, then the ATO has flagged in these tax determinations that there may not be a sufficient nexus to the derivation of assessable income for the interest on that interest-bearing loan to be deductible. The actual diagram we're showing here is a not uncommon situation for private groups where you might have a management entity that might employ staff, incur overhead, salaries, wages, rent, And then all of the other business trusts might distribute income into that management entity at year end to essentially, soak up those deductions. Now, it doesn't automatically follow that those deductions might be deductible if that management entity is just a discretionary object of those two trusts in that situation. And that's a similar matter to what the Chadbourne case looked at a couple of years ago, which is what the reference is there at the bottom. However, care should be taken in assuming that certain deductions might be deductible. But one item where you could look to address that is, instead of the management entity just incurring all the expenses and then receiving trust distributions at year end to absorb those expenses, the management entity would then look to on-charge those expenses to all of the other entities prior to 30 June. And if that happens, that really changes, the impact of the tax determination in the Chadbourne case, because rather than the management entity just receiving distributions from the trust as a discretionary object of the trust, it's actually on charging those expenses by way of a management or services fee. Another item for trusts, which we're seeing more and more of over the last couple of years, is looking to restructure business activities out of a trust and into a company. Some of the key benefits of doing so would be to access the lower corporate tax rate. So if your turnover is less than 50 mil, the tax rate now is 25% for business entities. You can also significantly reduce Div 7A compliance, because you're paying tax at the corporate tax rate, and it's only really once the shareholders need that dividend that you can pay a dividend out, rather than in a trust. If you're distributing to a corporate beneficiary, you're then trying to manage that Div 7A loan every year. There could be some, there is CGT rollover relief. There's CGT small business concessions, potentially the CGT small business restructure rollover, that are all potentially available to defer any tax on the transfer of assets from a trust to a company. And so that should be able to manage the income tax side of things, so there's no tax payable on that restructure. But other considerations which we've got at the bottom there would include GST, so whether the going concern exemption might be available. If we're transferring business assets in certain states like Queensland or Western Australia, consider whether could be a stamp duty liability if you're transferring business assets and goodwill. And also, if you're transferring the business assets into a new entity, consider a lot of your contractual arrangements. Do you need to get consents and approvals to change the entity type that's carrying on the business? So now we're going to move on to the final part for today, which is talking about some key year-end matters for companies. And so we've got 8 key items here that, often a key item around companies in year-end matters is Division 7A. So the benchmark Div 7A rate up to 30 June 2023 is 4.77%. With the increase in interest rates over the past 12 months, that Div 7A rate is going to increase significantly from 1 July. We expect it to be about 8% or a touch over 8%. So if you've got Division 7A loans in place that are funding with a loan funded private expenditure and where the interest isn't deductible, if that rate is going from 4.7% up to 8%, you might want to consider refinancing or repaying those loans, because if you're paying 8% and paying tax on the interest but not getting a deduction, that's a real sort of significant tax cost of that loan. Div 7A can apply to loans, payments, and debt forgiveness. So it's key to identify all intercompany transactions to see whether they might be subject to Division 7A, and also important to consider the distributable surplus of the company in relation to the year that the loan was made or when the debt was forgiven. Please ensure all your loan documents in place. A lot of Div 7A arrangement loan agreements operate as a facility agreement, so you don't need to enter into a new one each year. But if there are new Div 7A loans between a company and a new entity or a new family trust, make sure those loan documents are in place. In relation to investment agreements, you'll see I've got a question mark there against investment agreements. Well, on the following slide, we'll talk to some recent changes again in the ATO's view on Div 7A and UPEs, which are really going to, stop the sub-trust investment agreements going forward. But we'll touch on that on the following slide. Some key watch outs in terms of Division 7A, please, ensure that reborrowings don't occur. So if a loan repayment is made, but then the funds are immediately lent out again or not soon after lent out, even through interposed entities or other group entities, there's a particular rule that can actually deem that repayment to not occur, which means you've missed a minimum repayment. So please be careful that repayments of loans aren't immediately lent out to other entities. And also consider transactions through interposed entities. So you might have a loan from a company that's unprofitable and doesn't have a distributable surplus that you think may not attract Division 7A because of the distributable surplus rules. But if that unprofitable company has actually sourced that cash from another entity within the group that does have large retained profits and would have a distributable surplus, then Division 7A can apply through these interposed entity rules. So it's the key watch out is to make sure you're not looking at just the company in question that's made the loan, but also look at whether there's any sort of loans through interposed entities. So also in December last year, when the ATO released their 100A guidance, we also had further updates in relation to unpaid present entitlements between a trust and a company. And again, the ATO has really changed a long-standing and well-understood practice that has been around since about 2010. By way of background, in 2009, the ATO introduced really that loans or UPEs from a trust to a company are essentially loans for Division 7A purposes because they're financial accommodation, not loans at law, but loans for Div 7A purposes. And so since the 2010 year, any unpaid entitlements between a trust and a company have essentially been subject to Division 7A. Taxpayers have had the choice of putting in place a Division 7A loan or a 7 to 10 year interest-only subtrust arrangement. However, in tax determination 2022-11, the ATO have really sort of stopped, the ability to use the subtrust arrangement. And so only now in very limited situations could a 7 or 10 year subtrust arrangement be permitted. And this is really an important change and to be aware of because this has been well understood since 2010. Essentially, I mentioned that subtrusts going forward will have a limited operation. The ATO said that it really needs to be a full quarantining of any distribution to a company on subtrust, so that 100% of the distributions is permanently set aside, for example, put into a bank account on subtrust. And if, other than that, so if any of the funds that are the subject of the UPE are used by the trust or used by any other related family member, then that will be financial accommodation for Div 7A purposes and will be a loan. So practically, I think these subtrust arrangements will not be going forward, and all UPEs from a trust to a company will be subject to Division 7A. I know I've only got a couple of minutes left, so I'll get through the last couple of slides. From a Division 7A perspective, whilst there's this change of interpretation and approach going forward from the ATO in relation to UPEs, it's not going to disturb existing UPEs that are on subtrusts, and it's not going to impact on any pre-December 09 UPEs, which have been essentially quarantined from being loans for Division 7A purposes. In PCG 2017-13, which is really in 2017, the first of these 7 or 10 year subtrust arrangements started to expire, and the ATO published this PCG, which allowed 7 or 10 year interest only subtrust arrangements, once they got to the end of that arrangement, to be refinanced to a 7 year Division 7A loan. Was essentially gave groups up to 18 years to fully pay that distribution to corporate beneficiaries. So that's still going to be allowed for existing subtrust arrangements. So there's no need to change existing arrangements. But please note, much like with the Division 7A rates that are going to be increasing from 30 June 2020, from 1 July 2023, the interest-only subtrust arrangements is also going to significantly increase from 1 July. And whilst the rates haven't actually been finalised as yet, we expect the 7 year rate to be increasing from 4.77 up to a bit over 8%, and their 10 year rate to increase from 6.82 to a touch over 10%. This slide sort of shows the history of the ATO's treatment of UPEs. I guess the key takeaway is that the ATO like releasing bad news on Div 7A in December. You can see Division 7A was introduced in December 97. UP Easter companies were flagged as them being subject to Division 7A in December 09, and in December last year we received all the new guidance on 100A and the changes to UPEs and subtrusts. Finally, we'll talk to some key measures that are remaining. We've got another 6 or so weeks. The first one is temporary full expensing. So temporary full expensing is in place until 30 June 2023, and it currently applies to all businesses that have turnover, aggregated turnover up to $5 billion, and there's currently no asset cost threshold. This has been, I guess, a well-received measure over the past couple of years, because essentially any new depreciating asset has been able to be written off in full. From 1 July 2023, and this was an announcement in this month's budget, that whilst the TFE rules won't be extended, they'll be replaced with the instant asset write-off, and that's going to apply for small businesses with turnover of less than $10 million with an asset threshold of $20,000. Whilst the TFE rules predominantly apply to new depreciating assets, if your aggregated turnover is less than $50 million, then the TFE rule should also be available for second-hand assets. In addition to the TFE rules, we also know that the loss carryback rules are going to be around for another 6 weeks or so. They apply up until 30 June 2023. The TFE and the loss carryback rules are a bit like high school sweethearts who met in primary school, married, and spent their entire lives together. Much like that, the TFE rules and loss carryback were introduced together in October 2020, and are both going to depart this world from 30 June 2023. But we have got another year where the loss carryback rules can apply. And that's going to enable corporate tax entities only to be able to essentially carry back a tax loss to an earlier year, rather than carrying that loss forward to a future income year when taxable profits have been made. The amount of the tax offset that's able to be obtained is capped or limited by the franking account balance of the company. It's important to know it doesn't apply to all tax losses. So losses that might have been generated through excess franking credits, the loss carryback rules don't apply to those losses. But these rules won't be extended from 1 July. Company tax and franking rate. This is, obviously we've got a 2-tiered company tax rate now. So the default rate is 30%, but the 25% reduced rate, there's 2 requirements that need to be met. The first is that the aggregated turnover is less than $50 million. Now it's aggregated, so there can be some complexity in identifying all connected entities and affiliated entities. But the second requirement really is that passive income for that company is less than 80%. If those 2 conditions are met, then it's the 25% tax rate. And from a franking perspective, if those conditions are met in the previous year, then the franking rate is at 25%. I know I've only got a minute left, but a key year-end tax planning item for company tax rate and franking rates is we've got a lot of companies that have historically paid tax at 30% and now may only be able to pay dividends out at 25%. In many instances, that will be the case, but if we've got profits trapped in a corporate beneficiary, with some careful tax planning, you might be able to pay dividends out at 30%. And the key there is, from a franking perspective, you look at the income that was derived in the previous year. So if a company has made 0 income, it would then have to frank dividends at 25% in the following year. But if that company's made $1,000 of interest income, and that's its only income that is derived in that year, then in the following year, it should be able to frank at 30% tax rate. So with some careful tax planning, sometimes over a 2-year period, you might be able to have those historical retained profits that have been taxed at 30% and be able to pay them out as a dividend at 30%. Now, note we're at 1 o'clock, and so that actually gets us to our final slide. We've got some key areas of focus there for companies, most of which we've probably spoken about today. So I think that takes us to the end of our session. Thank you to all for joining us on the webinar today. Should you have any questions, obviously we've run out of time to answer your questions that you might have put in the Q&A, but please reach out to your usual Pitcher Partners contact should you have any questions or want to discuss today's session any further. But thank you for your time.